How difficult is it for a loss-making company today to convince SEBI or whichever regulatory body is in to convince that we will be profitable in the next 1 year, 2 year, 3 year, whatever?
So actually two questions. First of all, what if a person, one of the founders is buying multiple rounds, 3-4 rounds,
Okay.
and now he's looking for exits? How does a founder plan for that? Because the duration for every exit and every term sheet is different, right? It might
Yes.
be-
Early stage, in most of VC-backed companies, you would see at least say Series A, Series B founders having control over the business. Okay? So VC has to make that effort to build that repo. From a founder's perspective, you also have to buy their trust.
The intent of today's podcast is very simple. I guess there are a lot of people on various media platforms today that are talking about कि पैसे कैसे raise करने हैं, funding कैसे raise करनी है, how to get a VC to fund you, how to get an angel to fund you. But there are a lot of fine lines that come after you have received the money and not exactly received, but you've gotten a deal. Now you have to sign it. I guess there are a lot of
You received a draft term sheet.
Yes.
From a VC.
Exactly, and you are on that negotiating table. But mostly, even from a few friends, I've heard that you आधी बार first time में आपको समझ ही नहीं आती है चीज. Even if you try to ask some people, or a lot of people don't even have the specific knowledge as well to help you in those situations.
Yeah.
So we would want today's podcast to be that 1.5 hour masterclass for someone who has received a draft term sheet and wants to take it forward from there.
Certainly. First of all, thank you very much, Ayush and Dhruv, for having me here.
Ashwwani, for being there for the podcast. I think we're going to cover a lot more in the podcast. For anyone who is probably an 18 to 24 years old, has got his first term sheet. So this is going to be a post-term sheet playbook fundamentally.
Yeah, I'm sure exciting phase for any founder. You know, maybe a major milestone. The first big step they're likely to take once they receive a term sheet. Journey may or may not be, as they would have hoped for, as they would have wished for. But let's see if we can solve some questions for them and make it a useful session for them.
Very basic and fundamental question. So most founders just think that paisa raise kar liya, that is a point of achievement, that is the goal. However, it is just a starting line for building something on, right?
Yeah.
So how do you think that journey goes? Well, the entire ecosystem is glorified raising money, but what is it in reality?
See, if you look from a founder's as well as a VC's perspective, to a large extent aligned, but there are some timelines attached to everything you do. So if you have raised a fund today, say example, we are raising a seed or a pre-seed round, any young folk coming up with a good business idea and able to get some validation from a VC, able to raise certain funds or get at least some commitment. But the process of building that business or a viable business, that process has just begun. Or maybe is in just an early stage. We don't know if like it's a product market fit stage or an MVP stage. If it's a seed round, you're still figuring out who your potential customer is likely to be, or you're still maybe raising money to develop a product or a service. Once you start selling that in the market, you are receiving feedback from end customers, and obviously a lot of value add comes from VCs, what to do, what not to do, how to speed up the processes, how to scale your business. The end goal is a viable exit. First of all, a successful business, a commercially viable business, and then an exit for at least your investors. On an average, I've seen VCs targeting an exit around 6 to 8 years time horizon, and that's the minimum any business would generally take to reach its potential. Though obviously, the company may continue to expand the business later. The founder may be passionate to solve that problem, keep building that business forever. But if you see from a VC's perspective or a practical perspective, you need to invest some time to make it worth investment. You have raised that capital to obviously scale your business, build a product. Once you are able to generate enough revenue that it is suitable for the next investor who has the ability and who is aligned to provide an exit to existing shareholders, that's when I can say the first major milestone achieved when it comes to the end goal. Raising money is, I would say, arranging your raw material. You have figured out your raw material, but the processed good, processed service, delivering that, taking feedback from the market, product evolution, service evolution, a lot of things happen. And then you reach a stage where the market has accepted you as a service provider or as a company providing certain products, solving a problem. And once you scale that to a decent level, That's where an exit opportunity may arise, maybe the first long-term goal met for either a shareholder or an investor.
Got it. Fair. So, what fundamentally changes in a company once, like we are discussing a case of someone who's in the industry, 23, 25 years old maybe, raised a crore. It's a D2C, so a consumer brand. How does the life of the founder change after raising the money? How does the organizational structure, the day-to-day working change?
So there are few things which will remain the same, which is like your legal structure, most likely if you have opted for company as a business model or legal structure. But a lot of discipline has to be, I would say, integrated in the day-to-day processes, in the macro level decision-making process. So the moment you are bringing another investor or a venture capital fund on the cap table, they are likely to get certain rights. These are the experienced people who have seen, who have built multiple businesses, worked with multiple founders in the past. As I was mentioning earlier, they know what to do and obviously what not to do. What policies or what practices have not given the kind of result that a founder may think. And here we are talking about a youngster who may not understand the macro level dynamics to that extent. VCs, they do this for their bread and butter. This is their bread and butter. They do this on a day-to-day basis. They have built businesses with multiple founders in the past. They bring in all that experience. So to enable them to provide that value add, they will seek certain rights in the term sheet. These could be primarily around the governance rights. They might take a board seat along with the founder. They might have some affirmative voting rights where if some macro level decisions are required to be taken, a VC's prior consent will be required so that they get the ability to evaluate the pros and cons of that specific corporate action. And if this aligns with the long-term vision they have for the company, and also the founder, obviously the founder would be the individual or the party that would be initiating any of those corporate action. The VC would either give their consent or guide the founder to move in maybe the same direction, slightly different direction, or to discard that decision altogether. So when you are working or say building your business all alone, you are the one taking all the calls. But the moment you include a think tank, right? VCs are not just there for the capital. They bring in a lot more value on the table, a lot of experience, which helps you save money, which helps you scale, which helps you achieve a lot of business goals in tried and tested manner, So if VC has given you that capital, they would prefer to be listened as well, to be included in the decision-making process. That's where the guidance level comes into the picture. So as compared to you being the only individual taking all the calls, or as a founder group taking all the calls, you have some experts with you, and you will have to take them along. There will be a lot of reasoning that will happen for every macro level decision making, or every macro level corporate action. So align with them. This is something you will have to get used to.
The benefit of also being an angel is that you have to deal with way lesser structures in place as compared to VC probably. And the second thing is, because he's not doing it for his bread and butter, he's already built businesses. He's much more relatable to the founder that I've kind of noticed and talked to. Versus a VC is fundamentally not built businesses. He is being the ecosystem and trying to support that. Is it the case?
So again, pros and cons on obviously both sides. You're correct. People go to angels to get that early stage support. The closing happens in a much faster way. So for example, a typical VC round closure may take anywhere between 2 to 4 months, right? Every startup cannot wait for that long. So and early days, you may not need that much capital also. Like you will generally see the founders are the only individuals working on the product. Very common. Say for example, 4 techies, they come together, they're trying to build something. So if they're just building that product or that tool at that specific time, they may not need a lot of capital because they don't need additional human beings as resources. But obviously they need a lot of guidance. They may have to invest some money in the tech infrastructure that they are building, some tools that they have to subscribe to, some guidance on how to how to create the architect of the tool that they are trying to build. So from that perspective, an angel investor can be very useful, and you may not need those millions of dollars. That comes at a slightly later stage. So early stage, if you're still trying to figure out your MVP, your tech infrastructure, I think angel investment makes sense. But still, you have to do the same level of diligence while identifying an angel investor as you would have done for a venture capital fund. Like, I don't think a founder, okay, there are desperate times when a founder may opt to raise money from anyone, from anywhere it's available, as compared to, I would say, the right approach, which is to do the same level of diligence that a VC would have done before investing in your business or in the team, for that matter. So, since you are getting someone else on the cap table, if you are able to negotiate a transaction with the angel investor where there is zero interference in the governance rights, I would say that's the right approach. And that is how the market actually works as well. But there are always exceptions. If an angel investor is asking for a lot of rights, a lot of, I would say, interference in the day-to-day operation, that may or may not be the right fit for you. So you need to figure out who, from whom you are raising money, what role they are likely to play in your day-to-day operations. Are they going to interfere at any stage at all? VCs definitely, since they would be coming up with a slightly bigger check, the level of experience they are bringing in, they would love to have what are the market practices for them to have certain governance rights if they are investing a certain amount in the business. Like for seed stage, even a VC may or may not opt to have governance rights. But I'm sure they'll have some say, they may have some say in corporate actions that you are likely to take, some macro level corporate actions you are likely to take, in which direction you are taking the business. But early stage, try and have as much operational flexibility as possible. Even when you are taking investment from a venture capital fund, and venture capital funds, they're very much comfortable with the founder having operational flexibility, at least in the early stage. Obviously, once the business scales to a specific level, we have multiple investors on the board, then things may change. But even, I would say, at like Series B, Series C, in my experience, I have seen mostly founders having a lot of flexibility as far as operational matters are concerned. The moment it comes to macro level corporate actions like fundraise, exits, or maybe, changing your business line altogether, introducing new product services, because everything comes with a lot of cost attached to it. So there, venture capital funds, growth stage funds, they do prefer to have a lot of say. But early stage, I think operational flexibility is something you should be looking for. And if you are getting that from an angel investor, it's not a bad option to have.
What are some of the most basic traps that you've seen most first-time founders fall into?
It's a subjective term, but yeah, I know what you are trying to say, because again, see, the ecosystem in India, when it comes to VC investment, is still evolving. Obviously, we have come a very, I would say, very far when it comes to the development of the ecosystem, with new participants joining when it comes to say micro VCs, family funds, and maybe angel investor now in lakhs instead of say hundreds or thousands 5 to 10 years back. So trap, I would say the first and the foremost thing, how much dilution the VC is looking at, right? If you want to build a long-term commercially viable business, you're likely to raise funds at least like 2 to 3 times. That's the minimum that we have seen. And the number can be significantly higher for a business which is burning a lot of cash. If you end up diluting 30, 40, 50 odd % in the first round itself, I think that's more or less a big no-no, the way I look at it.
I just cut you short there, because in that case, is the angel or the VC not also thinking of the same perspective कि अगर first round में 50% dilution ले रहा है, founder मुझे दे रहा है, how does this person plan to sustain the company to take it to a place where I can take an exit?
See, the world is not fair, and it's not even supposed to be. Everyone has to be smart enough to protect their own interests. You may not get the fair VC every time, and every situation, market condition may not, may not create space for a fair transaction. Different market cycles, different results. How desperate you are as a founder to raise capital also matters. Which VC you are dealing with also matters. If there is a VC who wants you to build for them, there is a very high possibility they will try and get as much equity as possible at the first instance itself. So you should have some number in your mind, right? This is the level of dilution you are okay with. It should not happen that by the time you hit Series A, Series B, you already realize that the business is now already owned by someone else, directly, indirectly, and you're building for someone else. The founder may lose interest. So from a VC perspective, it's important that the founder has skin in the game. There should be some incentive for the founder to continue and build. But from a founder's perspective, right, there's something you need to figure out. You are passionate about this business idea. You wanted to solve a problem for the world. If that opportunity is being given to you, what is the cost of that opportunity? And see, again, market is full of these kind of situations where founders lose a significant shareholding or significant position on the cap table in first couple of rounds itself. It's a significantly high cash burn business. You have no option either to shut down the business or just keep raising money, and then you'll see the founder in say single digit shareholding very, very soon. So you have to keep in mind what will keep you interested, right? If and how desperate you are to raise funds. If you have no other option, would a job would have been better to solve something instead of just building a business where you hardly own anything. So dilution definitely is one of the most important factor. Then the reason that you are not working for someone else and have started something of your own is because you were expecting some operational flexibility. You wanted to do something on your own. All of a sudden you are sitting with a share like a cap table construct or a governance right construct where for everything that you wanted to do you have to reach out to a third party. You may or may not like it. You may lose interest in say a couple of years time. So figure out the core reason why you opted to build a startup instead of maybe building something in an old school manner or working with some other organization and building for them.
What are the 2-3 main segments in a term sheet that you think a founder should be very careful about? Like you said, liquidation preference, governance rights and daily operation rights, and what are the rights to the
Economic rights.
Anything else that you see should be very carefully taken into consideration.
And if you can explain those rights,
Yes.
Okay. So as I said, dilution most important. This is like what percentage of your shareholding would be diluted when you are raising capital. Obviously, there will be creation of ESOP pools that will result in further dilution. But something you should understand, what is common practice in the market, easily available. If you are reading, there are a lot of people who have written about it. There are a lot of people who have spoken about these kind of rights. So this information is available. If you if you're not able to figure this out as a founder, then maybe you were not prepared for the fundraise. So dilution, most important. Then governance rights. Operational flexibility is very important for a founder at early stage. You will obviously have to share it with the venture capital fund when you are bringing them on board, but excess of everything is bad. So you need to figure out what's the right balance. Early stage VCs don't look for control. That's for sure. Like most of the fair VCs, at least I can say, the market practice, let's not say fair VC because obviously it's more around market practice, market cycle, how the company is doing. So there's no, I would say, one rule that fits all. But try and retain operational flexibility in the early stage, but obviously once you reach Series B, Series C, you will see the more of investors participating on the board, more or less at par with the founder, and gradually as the company grows, you will see more investors as compared to the founder nominee on the board. Affirmative voting rights is something you will have to live with. First round you are raising from a VC, you are likely to get that, but it's only around macro level decision making. It's not on the day-to-day operations. Economic rights are very important. It's your liquidation preference, how the money will be distributed if there is a liquidation event. Anti-dilution is also important. There are market practices around it. If you are, unfortunately, you are forced to raise any future round at a lower valuation, like down round, then what would happen to the investment you received in the past? Would they get any better terms? So there are again market practices around it. This can be on broad-based, weighted average anti-dilution. Narrow-based is also there. Full ratchet is also there. Full ratchet not used as much, at least if we talk about the top 5-10 VCs in the country. So okay, now let's get more technical here. So full ratchet is say you raise your first round at say a $10 million valuation. The next round happens at say $7.5 million valuation. So the amount that you would have raised in the previous round, even that would convert at a $7.5 million valuation. What does that mean for a founder?
The stake with the investor will go up.
Investor will go up and the founder will go down.
Yeah, who's going to tell you this?
Yeah. So the market, and this is something which is not only limited to India, to be honest, something a good practice that started more or less in the US ecosystem, and then most rest of the world also adopted this. We more or less switched to weighted average treatment. So this also took into consideration the dilution that's happening in the down round. So that made sure if you actually work around, it is a formula driven process, primarily taking into consideration what equity you are raising in the down round, how much dilution happened, at what valuation the down round is happening. The dilution or the benefit or the protection you have offered to your last round investor, it's fair, but it won't be that exact 7.5 in most of the cases. When you're talking about even a 25% down round, the weighted average mechanism will make sure the downside protection offered to the previous round investor would be limited to 5 to 7% at best.
Can you give an example on weighted average? Like just take an example of and explain how weighted average works.
So then it will get a lot more technical. It's a as I said, it's a formula driven process. But say same example, $10 million. Next round happens at $7.5 million. So most likely, if you will run the numbers, we're talking about it would take into consideration what amount you are raising when you are doing the next down round. Say it's a smaller amount. So first round, you whatever.
बहुत छोटा round up raise कर रहे हैं तो उसके कारण पहले वाले को बहुत ही
They won't get significant unfair advantage.
significantly damaged in that.
Yes.
So you will when you run that formula, most likely it will turn out to be say 5% dilution at best instead of 25% that we were discussing in the earlier example. So again, from a founder's perspective, things may or may not be in your control, right? Valuation is not just dependent on the business performance. Like I would say, same level of say financial matrix can give you certain valuation in one market cycle as compared to another, right? And market cycles will keep happening, valuations will keep changing. Say if we talk about last 3.5 odd years, at least the market perception is it has become quite difficult to raise funds. But when I see the last, I would say, an extremely founder-friendly market condition, the second half of 2020 and the entire 2021, founders were able to raise a lot of capital, and at I would say significantly higher valuations. I don't know even if they had that kind of valuation in their mind. So there will be market cycles. Accordingly, you may be forced to raise money at say lower valuation. The business matrix may change, your performance may change. So you cannot rule out a situation because you're talking about like an 8 to 10 year journey here. A very high possibility that most of the startups may go through that cycle where they have to raise money at a much lower valuation, or say lower valuation. Let's call it lower valuation. Full ratchet simply means all your past investors, they get the advantage if they have invested at a valuation higher than your latest round. Yeah. So full ratchet gives them or puts them at par with the lower valuation which is applicable to your latest round. Broad-based weighted average, narrow-based weighted average, what that does is, as I said, it takes into consideration the dilution that has happened in the latest down round. Sometimes you have to raise a small amount. Say for example, you ended up, let's call it candidly 1 share. So last round 1 share, you raised like $2 million at say, as I said, $10 million post. Okay, let's call it $10 million post. Then you issue 1 share at say $1 million valuation. Full ratchet will ensure that those $2 million converted $1 million valuation. Doesn't sound fair? Because you issued only 1 share for whatever reason. Because broad-based weighted average takes the number of shares being issued or the percentage of dilution that's happening in the down round, it protects the founder and their dilution in this scenario. One share, okay, then that for that $10 million, most likely it will become a $9.999 million valuation. So it doesn't impact anyone much.
Which is fair.
Certainly. So market has accepted this. So most of the bigger VCs, at least in this country, have opted for or they more or less agreed to broad-based weighted average anti-dilution protection. But again, there will always be exceptions, as I said, depending upon the nature of business, depending on how the business is performing. Sometimes they still may ask for full ratchet anti-dilution protection if the situation demands that. So I would say 90-95% of their transactions would be around broad-based weighted average, but there will be exceptions.
In these situations where both the VC and the founder have the right intention, there are certain decisions that are needed to be made. Now, instinctively, there are a lot of things like founder को decision लेना है, लेकिन अब आप deadlock situation आ गई. How do those things go? Both of them know that at the end of the day, both of them have the right intention, but yet both of them are looking at different paths.
Yes. Adding on to the same question, deadlock situation in the case जब VC के पास board rights है, governance rights है, he has some decision making power. How does that work in that case?
So, okay, early stage, in most of VC-backed companies, you would see, at least till say Series A, Series B, founders having control over the board, okay? And that is where most of the corporate actions are triggered. That's the beginning, right? You will need a board resolution and then rest of the approvals will come into the picture. So, control is with the founder. And most of the corporate actions will be the founder or I would say founder nominees, founder board members who are initiating a corporate action. So when it comes to starting a corporate action, you will see the founder taking the lead. Okay. Now, if it's a macro level change, fundraise, new business line, massive expenditure, some massive loan, hiring CXOs, that's when you have to reach out to the venture capital fund, who may or may not have a board seat but has affirmative voting rights. So you need to bring them on board. Why? You have to reason with them that I want to take this specific corporate action or this specific action, and this is the reason I want to take this action. Given is their capital which is being utilized, plus as I said, these are people with a lot of experience. They have seen a lot of things happen. So you take their guidance, you ensure that they are also aligned with the pros and cons with that specific action, and then they are able to give you the consent. If that can happen, nothing like it. But the deadlock situations cannot be ruled out. It will always happen. One is obviously the board construct is such. Say for example, you have two founder nominees, two investor nominees. There are two VCs, so there are two investor nominees, and two parties say yes, two parties say no. First deadlock. Or you want to execute something as part of the affirmative voting list items, and the VC says no, I don't want to do this. Or the VC is trying to guide you on a specific thing, and as a founder, you don't want to execute it. Possible. It need not just be a corporate action, right? Ultimately, it's a balance between two parties who can decide in which direction the business should be moving. If you want to achieve something, the VC says this is the best way to achieve it, but as a founder, you do not align with the process. That can happen anytime. So even VC will try and reason with you, first of all. If you both don't agree, there can be legal structures. So there are two parts to everything, right? One is how you structure it legally and how the life may change practically. One is you set out in your agreements itself when you're talking about a deadlock situation that if there is a deadlock situation, one specific party, if they have voted in favor, that thing will happen. If they voted against, it won't happen. It can be the founder, it can be the VC.
Something like a veto power.
Similar to that. Even if say, we get into that situation, even on veto, if there is a deadlock, you can create as many layers of approvals as you want to. But yeah, you can say if it's in relation to operational matters, founders will have a say. If it's in relation to things which are in the AVM bucket, then the VC will have a say whatever they want to go with. That will be final. The thing is, you also have to evaluate if that impacts the relationship between the two, the long-term impact. Because if deadlock situation is happening again and again, like every now and then that means there's a much bigger issue to be solved. Then maybe you sold a different vision, or now the VC wanted you to achieve it in a slightly different manner, but things are not aligning now. So I think that's the stage when both the parties should spend a little more time, come at the same page, at least at the macro level steps, and then take things forward. Because see, as I said, agreement. Okay, you can sign as many agreements as you want. Ultimately, you want both the parties want something from the other side, which will make sure they are able to achieve one common goal. Not just value creation in terms of commercial gains, but to build a business. It's a long process. There will be a lot of ups and downs. And as I said, both can be each other's best friend. So macro level alignment is very important. Deadlock situations can be avoided if you are aligned at macro level.
So now that we have discussed that how setting up SOPs, having structures in place and everything can help prevent deadlocks, I would like to go to the next question, which is what are the biggest legal reputational risks that a VC tries to safeguard against any founders except and how do founders fundamentally manage that?
The timing is apt for this question. Last 3 to 4 years, there has been like so much emphasis on compliances, financial checks. The ecosystem, again, I don't know, fortunately, unfortunately, the ecosystem has gone through some, I would say, massive incidents around the compliance practices, the internal financial controls, checks, and the names and the stakes were like massive here. Like the biggest of the companies, biggest of the startups, decent number of unicorns, and there were allegations around the compliance practices, the internal checks practices, internal policies practices, financial mismanagement, and whatnot. So it's not just the company or the startup which gets or rather ends up paying the price for these kind of instances. All the VCs who have been associated with these kind of companies, they also get dragged. They also get a lot of, I wouldn't say bad publicity, but there's a lot of publicity around these incidents. And as a VC, you also get involved. The market expectation is that as a partner, and as to be honest, a mature partner, VCs should have guided or should guide companies in integrating and building the right practices at the right time depending upon the stage and scale of the company. Now, sometimes what happens is the companies scale at such an insane pace, at such a fast pace, that the internal practices, processes and checks are unable to keep pace with that growth. And the problem with, say, compliances or these checks and balances is if you do not integrate them at the right time, sooner or later something will definitely come to light. Something will definitely go wrong. Sometimes it can be intentional, but sometimes it just happens, like things just go out of control. So all of a sudden from say a 10 million ARR company become a $300, $400 million ARR company in a short span of time, 2 years, 3 years, shorter, longer, whatever be it. And your support teams practices do not grow at the same level, right? So there is a lot of flack that the VCs have received. There is a lot of value that has eroded in the last 3 to 4 years. Some like big names, biggest of the startup names. And it's not easy. It's not easy for anyone, either a founder or any individual from company side who is helping the company. All the VCs involved in some of these companies, obviously they were at such a stage that like, there's a long list of venture capital, growth fund or sovereign funds who were already involved, were on the cap table, had some governance rights. Despite that, those companies went through tough times. So that reputational risk always remains. especially for the VC. People think it's only limited to the founder. No, it's very well connected with the reputation of the VCs, because VCs take a lot of pride in the practices they help any startup develop, integrate, and that's why they have massive portfolio support teams also. A lot of resources are spent, a lot of time is spent on some of these teams, practices, but there will always be exceptions. Any VC having a portfolio of say 50, 100 odd companies, there are VCs with like much bigger portfolio, but after a point, that small percentage of exceptional cases cannot be ruled out.
Okay. Now that the term sheet has been signed, there's a founder-VC relationship being built, the business is in progress, but now a founder also needs, or a VC also needs to fundamentally think about exits, because as we discussed that they have a fund life. So I think we can probably start with that.
Right, sure. So like we were talking earlier, there's a fun, like a typical company has to give out an exit anywhere between 5 to 8 years, right?
Yeah.
So how do you start preparing for that? How, like when you know from your Prashant, like your VC sites, etc. How do you start planning for it?
See, first thing, there will always be a guideline set whenever you are signing a term sheet, or even you are signing your first round of transaction documents. There will be some guidelines, there will be some timeline, and there will be a waterfall. We call it exit waterfall. A typical exit waterfall is, you try for listing of the company. If that's not happening, you try and sell the entire company. Even if that is not happening, you at least try and create an exit window for the investors on the cap table. If that is also not happening, if the business has or the company has some capital on the balance sheet, there can be a buyback situation. Last worst case scenario, drag sale. Okay. Generally doesn't have, like, practically very difficult to enforce in India. But there are situations.
Why is it difficult in India?
You can, like any of the party which is being dragged can use legal recourse and delay the process. And delay the process, the delay can be significant and the business will keep losing value. Market perception in case of a drag sale is always negative. In most cases is negative. It need not be negative in all cases, but in most cases it's negative, and the buyer may not be interested for that long. Nobody wants to get involved in a legal hassle or legal tussle, to be honest. So
just for reference for the context and stuff, you mentioned that the 4 ways to exit are IPO, sale to another company altogether, buyback of shares, and drag along rights, like the
it can be like say a late stage investor buying an early stage investor's position. All of that
also
is used a lot, to be honest. It's used significantly.
fair enough. Can you just explain buyback and drag sale for the context of audience, and then we'll probably move on to the...
Sure.
So buyback is when the company has the ability. First of all, they need to have capital, or like say they need to have some money on their balance sheet which they can utilize to buy back certain shareholders' shares. Right? So the exiting shareholder will either get partial or full exit, and obviously every other shareholder has to be aligned, because buyback offer will go to all the shareholders of that specific class of share. So you have to align with everyone, create an exit window for that specific investor, and offer them a buyback opportunity. In most cases, what happens is startups, if you have reached to this level in the waterfall, startups may not have this kind of money on their balance sheet or capital on their balance sheet to execute a buyback. So partial buyback can still happen. Some money can go to a specific investor on the cap table. Drag is seen more negative, but where the drag right holder has the ability to force non-right holders for a sale, right? Say for example, if there is a sale opportunity, there is an investor or a company or any party which is willing to buy, say minimum 50, 75% or whatever percentage in the company, and one of the party could be one like another investor or a founder, they're not willing to transfer their shares. In those situations, to make sure that the buyer reaches a specific shareholding, could be 100% also, are forced to transfer their shares to the willing buyer, the prospective buyer. Enforceability is a little difficult when it comes to the process itself. I can't force you to, sign a share transfer form. I'll have to take legal recourse, go to a court, get an order against you that you were supposed to do something which you have not done as per the contract. That enforcement in it itself can take a lot of time, and in that duration, the prospective buyer may lose interest, the company may lose value. There are practical challenges, but yes, on paper, this right exists. If your business is structured out of, say, some other jurisdiction, may be possible to enforce at a faster pace. But yes, generally, VCs keep this as the last option. Have I practically seen any VC enforcing this in India? Not really. At least in no major incident in the last 8 to 10 odd years. Maybe growth stage or private equity investors can do this because they are already in control. They are likely to be in control of the business. Right. So the chances, yes. And they can even run the business if any of the founder is being forced to exit the company. Someone will have to run the business.
Right.
Who would that party be in the interim, the transition phase? So there are multiple factors which come into the picture.
I'll just go deeper in this direction. So we mentioned 4 ways through which an exit can be taken. We have discussed it later too. But the first one, IPO.
Yes.
Now, I feel like there are many IPOs coming up this year as well. I guess the most amount of IPOs in the last many years, I guess, are coming up this year, as far as I know.
Last 4.5 years have been amazing for the Indian startup ecosystem.
Yeah.
From VC's perspective, this has been great. India has proved itself to be, the perfect market, or at least the right market, where new age tech companies can get listed at good valuation, at nice valuation. Companies have gone through multiple cycles post listing as well. So Indian capital market has proved itself to be the right market for listing of a new age tech company, which is massive, which is like most of the other ecosystems, other than obviously like US is way ahead. China has been doing this since decades. So has US market, European market also to some extent. But if you see the Southeast Asian market, Indian market, APAC region, India is one bright spot when it comes to listing as an exit opportunity. And amazing valuations, businesses have delivered. If you don't deliver, see IPO, once again, glamorous, but the level of compliance is required, the level of reporting is required, public reaction.
That only. But like even one step behind that, what are the requirements to go public? Like, do you need, I've heard a lot of things like, okay, this many years of revenue, profitability, like, what is it?
I just want to add on to one question. What are the requirements and how does a founder plan for that requirement, considering I exit as well?
So preparation starts from a mindset. Okay, one is obviously like you have to offer exit to your investors. As a founder, you also get some exit. There is an exit opportunity, exit window for founders. So that's one way, right? You are able to encash on the value that you have built over years. But mentally, what all you have to be prepared for? You have to be a lot more disciplined. You have to comply with SEBI regulations. As an unlisted business, private limited company, the level of compliances are comparatively easier, lower as compared to a listed company. Listed company, every major action, corporate action that the company is taking has to be reported to stock exchange. Your financial reporting, quarterly numbers, everything has to be reported to the stock exchange. And then your investors, your public market investors, capital market investors, they will react to it. Sometimes it will be positive, it can be negative also. Then the market cycles in the public space or the listed space, they're far more visible. If the market is correcting by 20, 30, 40 odd percent, very high likelihood that your stock price will also be corrected by 20, 30, 40%, whatever it is. There are always exceptions if you're doing really well. But is in unlisted market or the startup ecosystem, valuation is what a VC or the next round investor is willing to give to you. It can be determined by one or two parties. That doesn't happen in a listed company. Valuation can just correct because the market was correcting. Market can be rational, it can be reasonable sometimes, may not be sometimes. So you will have to deal with those things. But so first, compliances, visibility, you'll have to deal with it, the volatility of the market, and you'll have to build that kind of team internally. You'll have to invest in a team which can handle these kind of compliances, especially like financial reporting. You'll have to start working on it at least 18 to 24 months before your stock has to list in the market, because the entire financial reporting ecosystem internally has to align with the financial standards, the accounting standards. Though they have to do it irrespective, but a lot more discipline because the timelines are short. So in a unlisted company, you can take like 15 to 20 days longer as far as reporting is concerned. But in a listed company, if you delay reporting, it's always seen with some negative perception. That can have an impact on your stock price.
Absolutely.
So that discipline has to be there. There has to be the right set of people who are engaging with the stock exchanges at the right time. From regulatory perspective, the level of compliances has to be the highest level. One non-compliance, because even the biggest of the companies go through this issue, right? RBI can tell even HDFC that you cannot issue more credit cards. So their stock price goes down. Like HDFC is like one of the most valued company in this country, and even they have to their stock price can go through some changes because of these actions. So you need a team. Like if you are receiving any such say notice, any such show cause notice, regulatory issues, you should have the right set of people, right set of advisors who can quickly solve the problem for you before it becomes too late. So that discipline mentally as well as in the entire organizational structure has to be integrated, has to be built in before you go for listing. Now, when are you eligible to go for listing? It's not that you have to be profitable. Now there are exceptions also. That's why like the Indian ecosystem evolving for the startups. Even if you are a loss-making company, but if you are able to give a profitability roadmap to SEBI, if they are convinced, then yes, you can still go ahead and get listed. Those kind of, so the market had to open up. The Indian regulatory ecosystem went to a very different level to make sure that it happens. Obviously, they came up with the right level of checks and balances to make sure the retail investors' interest is protected. But at the same time, they opened up this opportunity for retail investors so that they could invest in the new or the next market winners.
How difficult is it for a loss-making company today to convince SEBI or whichever regulatory authority they need to convince कि we will be profitable in the next 1 year, 2 year, 3 year, whatever?
So see,
accounting में कुछ दिखाना चाहे तो कोई किसी को profitable दिखा सकता है. But the question is how easy or difficult is it to convince them in today's scenario?
See, SEBI people are also very smart. What is one milestone for a specific company which is listing? SEBI does that on daily basis for tens of hundreds of companies, right? So they understand all these, I would say, gimmicks or the art of accountancy, financing better than maybe anyone else, right? Ultimately, it's the apex regulator who has to protect the interest of retail investors, make sure the companies are compliant. There are a lot of things that happen there. So even if you try and act over smart, they will figure it out. So there's a lot of, I would say, active engagement that happens with any company which is planning to go for listing, their advisors, their bankers who are involved in the IPO process, and the specific SEBI team that you are engaging with. They will go through all your documents in detail, all the processes in detail, projections in detail, the past performance in detail, the numbers and everything, EBITDA positive. If you are EBITDA positive, okay, burn might be higher 1 year, next year what's going to happen, next year is going to happen. So they do engage actively with all these companies. Once they are satisfied, okay, there is possibility of the company achieving profit in the near future or at least sometime in the future, and a lot of other conditions are met. The list is very long. All those conditions are met, then yes, they are happy to give you the approval for listing. So you would have seen, okay, though we said a lot of companies are getting listed, it's not very easy. You still have to demonstrate a lot of quality, a lot of discipline in your business, in your reportings to SEBI before you get the final approval. There are companies which have been trying for last 2 to 3 years, sometimes because of market cycles, sometimes because of the questions they receive from SEBI, the answers SEBI is looking at, that the IPO will get delayed. And that has happened. So SEBI has supported really well. The Indian capital market ecosystem has supported amazingly well. We have already seen some companies hitting valuations about $25-30 billion. New age tech companies. It's not a joke. How many $30 billion companies do we have in this country? So it's a massive validation for the ecosystem.
I guess
I have a question to on the same exit part itself. So actually 2 questions. First of all, what if a person, what if a founder has his mind multiple rounds, 3-4 rounds, and now he's looking for exits? How does a founder plan for that? Because the duration for every exit and every term sheet is different, right? It might be 3 years for one VC right now and कुछ 5 साल बाद होगा, तो वो कैसे plan out होता है? Because हमारे 3-4 साल में liquidation events create नहीं कर सकते हो, right?
So it's a very valid question, and to be honest, most of the companies go through it. The number of companies who have been able to go for listing with only 1 or 2 investors on the cap table is very rare. They are there. We have worked with those companies. Fortunately, there were like 2 or 3 listings we had where there were only 1 or 2 key investors on the cap table. It's like a smooth ride. Okay, timelines aligned, everything aligned. It's very easy to bring 2 or 3 parties on the table. But when you talk about new age tech companies, cash burn is very high, or companies where the valuation has, to be honest, become like very, very high, you would see 5, 7, 8, 10, 15 investors on the cap table. It can be much higher also. In the pre-IPO round, you would see a lot of investors joining. Now, 2 or 3 things which are key here. One, there is one timeline that you have already given to a Series A investor who came in like say very early, 6, 7, 8 years, whatever it is. There are 2 possibilities, because say for example, the first option we are looking at, IPO, it's not just that you wanted to get listed, so you will get listed. A lot of things have to fall in place. Business has to do well. Market situation has to be good. Capital market, the market cycle has to be good. You are getting the right valuation. There is enough appetite for, like from investors' perspective, for a business that you are running. Enough liquidity. Everything like there are too many things one has to ensure are in, say, right place. Only then an IPO can happen. So you can specify, okay, 5 years, 6 years, 7 years is when the company has to provide exit. But even a VC knows, or all the investors on the cap table know whether this is the right time to get listed or not. So these timelines do act as guidelines. If everything falls in place, let's go ahead. Okay, it's not happening. Then you look for other options, which can be like sale of the entire company. Once again, too many things have to fall in place. Founder should be aligned. If the buyer wants 100% of the company, is the founder willing to exit? See, we are talking about a set of individuals who are passionate about something, who at least, sometimes think that they want to, run this business forever. So founder has to be aligned. The buyer may ask for some transition phase. How are you going to accommodate that? Is the founder okay with it? Is the team okay with it? It's not just the founder. By then I'm sure the founder would have made a decent team around it. Someone is handling some vertical, someone is handling some other vertical. Are they all aligned? If it's a third party sale, that's still easier. You have to create exit window for one investor. That investor moves out. Like the next investor comes in. That buys you more time for the macro level events, like the biggest event, which is an IPO and trade sale. Because any new investor coming in will come in with, say, at least a 3 to 5 year window.
5 year window, extension.
Extension. So that's why depending upon the fund life of the early stage investor, either you can renegotiate the exit timeline. And it happens. It's not that it doesn't happen in the ecosystem. So if you had agreed for, say, 2030 as the exit timeline, and by 2028, 29, you realize you may need another 12 months, 18 months, 24 months, you can negotiate and extend it any further. If, once again,
Works for the fund as well.
it works for the VC also. If it doesn't, obviously you will have to create partial exit or some exit window for that VC and partner with someone else. Then you get additional 3 to 5 years. Once again, you need to negotiate. The new investor may simply say, okay, I come in 12 to 18 months, you have to go ahead and get listed, and then, I'll see, because there is a lockup right after the listing also for every investor, or rather every shareholder who was on the cap table on the day the company got listed or day before the company got listed. So they will all have those considerations in mind, and accordingly they'll figure out, and you can negotiate those timelines. So too many things have to come, or too many factors have to play out and fall in place before.
But at its core, either you create a third party liquidation event in which there's like another, or you renegotiate the terms, because it's very less likely for a person to go IPO for an initial stage investor and then give an IPO exit or a.
IPO happens only once. If IPO has happened, everyone is happy. Trade sale, the company is sold. Everyone is happy. Okay.
But those are very less likely events, right?
No. Okay. Yes.
At least in the initial,
Even say late stage company, every company cannot get listed. Every company cannot be sold. So you will have to create exit windows every now and then for your investors. If everything is going well, even creating those exit window becomes very easy. Late stage investor, they want to get more stake in the company, but you don't want primary dilution. You are okay with a split of primary, secondary, or just a secondary transaction, and then the early stage investor can exit.
So I think I have two last questions, one on the exit part and one as a suggestion to any person raising funds for SB. I actually want to discuss, and we also highlighted on this VC fund life and their expected IRR versus a founder vision.
Right.
So there are certain sectors which kind of start giving returns after X years, specifically when you're talking about tech companies, AI companies. They're taking multiple years for reaching a stage where they can now be probably profitable or have a path to profitability because they're heavily investing on R&D, etc. Versus a VC as a fund life, their expected IRR. How does that go? How does it? How do people how do founder VC battle that, and who they say
So forget about founders. Even some of the VCs have realized that working in a strict timeline or working on a strict timeline sometimes may not work for them. So some of the global VCs have come up with funds with no fund life. There is no time frame, there is no timeline at all. Because what they have realized is, if they would have continued, say, maybe for another couple of years, or maybe another 5 years, another 10 years, the returns could have been insane. Because see, every company goes through specific phases, right? They get listed, then you are out of the company, or you transfer the shares to your LPs if the regulations or the ecosystem permits. And then all of a sudden you see 5 years, 7 years, another market cycle, and the share is already worth, say, 10x, 20x, 30x of from where you had exited. And for you, it won't be 30x. It would be your base, your valuation for your first round of, second round of investment would have been much lower. So you're talking about multiples of multiples at a very different level. And the venture capital funds which have been around for a very long time have seen those 2, 3, 4 market cycles. They realized, they could have partnered for a slightly longer duration or a little longer duration with some of those companies. So they have come up with these solutions where they have floated now funds with no fund life. Okay, it doesn't mean indefinite.
Something, but it's pretty
Something is
extendable.
much longer.
Yeah.
Extendable also. Extension flexibility, some flexibility funds retain if they are able to negotiate.
Both parties and something like that.
So they are able to hold their investment for a longer duration.
Okay.
LPs can also be happy with this kind of a situation, because even when they are making, if they are getting exit from one investment, either they'll utilize the funds or look for the next investment opportunity. So this takes away that problem too. The compounding that's happening is at a very different level. The returns you are making are at a very different level. So yes, the fund life plays, again, here we were talking about exception, a minority. Well, once again, very few funds have been able to negotiate these kind of terms with their LPs. Majority, or say 90-95% of the market is still time bound. So yes, you have to work around those timelines, still giving whatever flexibility you can offer to the startup or the founders, and then figure out, what best outcome you can generate or best returns you can generate from or within these timelines.
But there can always be an extension clause mentioned within the term sheet in case of probably signing a term sheet, right?
From founder's perspective, if the VC is aligned, yes. Otherwise, you will have to create that exit for them. You will have to. There's no alternative. But okay, there's nothing called no alternative. If the company is not prepared for an exit, if there is no buyer, unless you book losses as an investor, you will have to.
You take your chances and extend a bit, and then
You continue on the cap table. What else can you do, right? But as per the market practice, the documents you are signing with LPs, one day you will have to liquidate all your investments and return the money. So yes.
I think the last question, and this is just like the final recommendation for any 18 to 24 raising funds. So for example, if there's a 23-year-old guy who's raised $1 million, what are the 2-3 key negotiables for that guy, or the girl probably?
Okay, irrespective of the amount, irrespective of the stage, one thing, again, I'm not an expert from an investor's perspective, but what an investor would also recommend to you is, as long as you're close to your goal, the passion, and the reason for which you started this business, I think retain that flexibility, retain that core goal. Otherwise, sooner or later you will lose interest. Dilution, most important thing. Operational flexibility, can't stress more on it, but very, very important, even in a desperate situation. Better to, if you can keep the business afloat without raising capital, don't raise funds from a wrong partner. It's very important, especially early stage. Otherwise, you will be distracted throughout. All you are trying to solve is for retaining your operational flexibility, retaining your shareholding in the company. You will end up building a business for someone else, which may or may not be the thing you were looking for. So to have that skin in the game, take those tough calls. Easier said than done. When you need capital, you need capital, and but taking money on wrong terms can be worse than not building at all. So you'll have to be a little tough even on yourself at that point of time. As I said, you can continue building a business for 8 to 10 years, but on someone else's terms. And then you realize neither you were able to create wealth for yourself, nor did you enjoy the journey. At least get one of the two. Yeah. If you are able to achieve one of the two, I think it's still like a win-win situation. Yeah. But you did not enjoy the journey because for everything you had to reach out to someone, you were dependent on someone else. Or you were not able to get a good exit for yourself. Then why did you go through this painful journey? See, excitement comes from the journey itself, like the ups and the downs. You understand the market, you understand the customer.
Fair. I guess that's a good concluding note for this amazing 1 hour, more than an hour of conversation.
Yeah.
Really enjoyed it. We have almost ticked off all our core questions.
Super.
Sure thing.
Thank you so much, Ashwwani, for joining us.
Pleasure.
And sharing such an insightful conversation. We'll surely love and have our audience also love this podcast.